there any dangers of only hedging financial products in USD? Do you think some countries or, why would some countries potentially move away from that?
Yeah, and obviously the dollar's a reserve currency and it's probably going to continue that for some time. However, we are actually seeing clients, etc., also moving away from the dollar. And actually the dollar the world is becoming sort of like a multipolar world.
Why would you say it's important for companies to take FX into account when working out their working capital strategy?
So FX, in terms of our clients, directly affects how much cash a business needs to operate.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast. Brought to you by Trade Finance Global.
Hello and welcome to TFG, Trade Finance Talks. My name is Charles Osborne, Director at Trade Finance Global. I'm delighted to be joined by Trevor Charsley, Chief Technical Strategist at Corpay, and Chris King, Senior FX Dealer at Corpay. So today we're talking about FX and hedging solutions. So Corpay is one of our new partners. You might have seen a few of them at inaugural Geneva conference. Trevor's probably sick of the sight of me. He's already been on a panel with me, but we've got him here today. But perhaps maybe a start for anyone that hasn't seen Trevor or Chris, perhaps you can both maybe introduce yourselves.
It's lovely to see you again, Charles. It was a very good conference. Senior market strategist here at Corpay. I have 25 years experience in the foreign exchange market, FCA approved.
Chris here. So I've been on the dealing desk here at Corpay for a couple of years now. I deal directly with institutional clients, corporate clients across the European zone. I have a background in treasury myself. So in terms of, where I am at the moment in dealing with corporates and institutions directly, that expertise of my treasury background and then also relationship management, able to help a lot of people in, corporates and finance teams with small departments be able to solve problems specifically around foreign exchange, which might only be about 5 or 10% of what they actually do. That's where I fit in.
Perhaps we can start this with a question looking at an extension of what we discussed on the panel, Trevor, when we were talking about the broader issues surrounding the SME and mid-cap market. But perhaps if we just focus specifically on the FX problem. So what are the main risks and problems around FX faced by businesses trading in multiple currencies?
It's been busy, goodness me, and it may well continue to be busy. Exchange volatility, obviously, the dollar was weakened by 10% earlier this year and has then bounced back by around about 2.5% since then. Is that volatility going to continue? Possibly, yes. So you get this lack of uncertainty. It's difficult to forecast cash flows. And of course, following on from that, then it comes down to, counterparty risk. Who have you basically hedged your FX risk with? The size of the counterparties. And actually just expanding slightly onto that, what sort of solutions can they provide for you? Are they bespoke or is it just off the shelf? And then, of course, you have to diversify your risk as well, because you want just to have one counterparty who you manage your FX risk with. So in that case, there's a lot of sort of moving parts that you need to be aware of and to hedge your risk in the appropriate manner. It's tricky for clients, to be honest with you. It's very tricky at the moment.
You mentioned, because my next question was going to be asking about how geopolitical uncertainty can exacerbate some of these issues. You mentioned how these issues that we've kind of been dealing with, you mentioned the dollar situation. So How has that changed things potentially?
I think the world is sort of getting used to the new US administration and the difference in behaviour. That sort of getting used to that, I suppose, really means that there has been an increase in uncertainty around the US and their sort of trade policies and what their aims are, sort of thing. So this has produced that additional volatility and that risk. And can that continue? Well, in actual fact, yes, it can. Really interestingly, I was on flying to Geneva for the conference. I sat next to a former WTO lawyer. Can you believe my luck? So we were talking about the legal challenge to the tariffs on the plane. And in their esteemed opinion, they actually thought that the Supreme Court challenge to the tariffs that have been brought by US importers could actually be successful and the tariffs could be struck down. So in which case, if they are struck down, what would the Supreme Court say? Well, actually, the Supreme Court may turn around and say, well, we don't want to damage the US economy. So therefore, could the president and the administration just replace the IEEPA tariffs with Sector 201 or different tariffs? They'd have to go through Congress maybe. So that would be 3 or 6 months. But also, which is an uncertain time, but also the US importers may well bring claims to the courts and say, well, actually, we deserve our money refunded. So that could be $100 billion worth of refunds. So that's the first thing. How would that be perceived in the marketplace? Possibly a weaker dollar. And that is supposed to be decided by the end of this year. So that was quite an interesting point. Yesterday, we heard some more comments from the president about a new Fed chair. Fed Chair Powell will be leaving in May 2026. but we have been promised sort of the new candidate by the end of the year. Now, in that case, will that candidate be chosen? President Trump says that he's chosen his candidate, but he's not 100% sure whether he'll go for the political choice or whatever, or politically correct choice. But actually, reading between the lines, whichever candidate they choose will possibly have a dovish look on interest rates, certainly at the moment. And in that case, if you name that Fed chair candidate, will the market not say, all right, we're going to get lower rates next year, regardless? In that case, you could get a weaker dollar from that. And of course, we've had the federal government shut down for 43 days. Now it's reopened, but we're not getting data. We won't get the October data for the October non-farm payrolls, which is very important. And we won't get that before the Fed makes decisions. We won't get that at all. But we won't get the November data until December the 16th, which means the Fed may not be able to cut rates before the end of the year. Meaning, could we get a stronger dollar again? There's a lot of uncertainty. That's really what I'm trying to say. And in that case, it's like, okay, fine, we need to look at this and just sort of hedge your risk and realize that volatility may well continue. That wouldn't actually surprise me if this volatility continued into 2026. Clients have to be very much aware of what that volatility brings. And although sometimes, if you've got funding in dollars and your expenses in dollars, that's fine. Going into the project, yeah, that's all great stuff. Maybe you have to buy some local currency. Okay, that's fine. But coming out, you may get your profits in local currency. And if there's a delay or something like this in your execution in coming out of the project and getting profits out, then actually there's a hedging capability there that needs to be addressed. And that's really what clients, we're sort of helping them with those exposures and understanding what their risks are from that one. So does that all make sense, Charles?
It does. It's very interesting. This is why they speak to an expert. That's why you guys are here. You mentioned things like tariffs and sanctions. And as you all know, it obviously was a major talking point of the Geneva conference, even all those months later. Previously, before that, I'd dealt mostly with how it's affected trade flows, but it affects so many other myriad of other things. So it's very interesting to get an idea of actually how that affects essentially what you guys are doing in the FX space. So it's a very good point. I personally agree. I think the volatility is going to continue, and I think there's going to be a lot of change even before the end of the year going into next. So very, very interesting stuff. Chris, just bringing the conversation onto you here. And, obviously, as you guys have kind of alluded to in the opening, Corpay's the biggest player in the market. You obviously have a few clients in the commodities trading space. Are there any other issues that are essentially kind of keeping them up at night, would you say?
Yeah, exactly. So I guess building on what Trevor said, for many of our commodities clients, FX volatility has become a concern as of this year, just with that dollar devaluation. I guess many are unaware of the risk until such a move goes against them. And I guess we've seen that happen for the first half of this year. I guess a little bit at the moment, there's some suppressed volatility. So it's not bubbling as much as, as a conversation in, say, Q3 and the start of Q4 here. Many of those events that Trevor has listed there coming into 2026, I think that will be a key conversation again coming into next year. Building on that, cost and revenues are often in different currencies for a lot of people in the commodity space, with their base currency being different. So even small moves can squeeze margins, especially in the commodity space where you're only dealing with profit margins of in the vicinity of, say, 2% up to, say, 10%. And a devaluation of the dollar this year in the vicinity of 15%, it's completely cannibalized people's returns just from an FX point of view, let alone the business.
Sorry to jump in there, just I was just looking, we were in Geneva and looking at the Swiss franc. It's incredibly strong. It's a sort of, should we say, quasi-managed currency. Inflation's pretty weak at the moment. Will the Swiss National Bank, produce negative interest rates to keep the Swiss from not being too strong? So there's a lot of things to look out on that. And obviously, we do speak to our clients in that aspect as well. So hopefully that helps clients as well.
And another thing, obviously, with some of these commodity traders, and I'm sure many of them are your clients as well, there's also a liquidity issue with a lot of them, working capital issues that they have to kind of navigate as well. Why would you say it's important for companies to take FX into account when working out their working capital strategy?
So FX, in terms of our clients, directly affects how much cash a business needs to operate. Integrating foreign exchange into working capital planning helps to reduce uncertainty. So hedging, if there is a net exposure. So the first thing is obviously for a company to look to see if they can naturally hedge. So offsetting cost with revenues. But then if not, potentially looking to negate that with hedging strategies, with risk management products, which is what Corpay and banks and brokers alike can offer. By hedging, a company gives visibility over the costs, say, months in advance. So they don't need massive cash buffers, which can help free up capital for growth. A key thing here to consider as well for companies, the hedge ratio. So it's not a matter of just saying hedge everything and on we go. Hedge ratios are key here. It's about deciding what proportion of exposures to hedge. For example, a company paying suppliers in Brazilian real over the next year can set a hedge ratio that matches its payment schedule. So for the next 3 months, you are going to be a lot more certain potentially over payments that you have going into Brazil. So you potentially have a higher hedge ratio, say 70%, for example. Whereas say in 9 to 12 months time, I guess your hedge ratio might be tailored off to a degree because seasonality, or it might fluctuate in terms of the supplier changing their invoicing, maybe having a higher confidence ratio for, say, the near term, particularly in the commodity space as well, makes a lot more sense relative to just hedging it all out 100% for a year. Bringing it back to hedging itself, it's about protecting your margins. That's where it sort of comes down to, is protecting your margins. And a lot of people kind of get this mixed up, is the hedging is the speculation. But by leaving your exposure open to spot, you're 100% open to the fluctuation of what the rate will be on that day. So effectively, you're at the roulette table with spot. And the idea around hedging or with forwards or structured products is to essentially move the odds back into your favor.
As we've said, there's been some working capital issues, I think, with a lot of these kind of traders that I'm sure you guys are definitely seeing. Also protecting against certain risks, I think, is vitally important. All of these kind of came out in the market over the last few months. How would you say credit facilities can be structured? Is there a way they can be structured to protect against these risks? And can hedging potentially alleviate some of that?
This is where FX credit facilities come in. So in our world, a typical hedging facility requires a 5% deposit upfront, and there'd be a 5% margin call on that, which can make hedging unaffordable to a lot of corporates. But with working with an FX broker that has a large balance sheet like Corpay or a bank, you can potentially waive deposits and potentially margin calls, which then shifts the focus from can we afford to hedge to what's the right hedge ratio. So that is absolutely key from that point of view, is working with a credible counterparty where you may be able to have a review of your financials and waive such obligations, which from our point of view is extending credit. So just to be very clear from that point of view, so take a European client of mine. They buy around $100 million worth of Brazilian real annually for calcium carbonate. Brazilian real, quite volatile. They have existing providers in Brazil for hedging, but they require heavy deposits up front and frequent margin calls just due to the volatility in the nature of that particular currency pair that they're exposed to. They reached out to Corpay, or we had a discussion about how we can potentially reduce this obligation on them. So we were able to structure a hedging facility for them, which had no initial margin and no margin calls. This client can hedge consistently and set up hedge ratios that align with their cash flows, which has helped them protect their profit margins without tying up working capital. From the time that they initiated their hedging program at the start of the year, so for 2025, dollar BRL has depreciated over 11%. Considering the tight profit margins that they work within, so around that 7% sort of profit margin, this has been a material success to that business for 2025 when we've seen that depreciation. So just an example of a success story there, because if they didn't have that hedging facility with Corpay, the cost of hedging for them at that point in time would have been too much, and that would have surpassed on that. But retrospectively, looking back now and where the dollar BRL rate is, I think we've been able to add a lot of success to that business. The result for them is, again, we focus around predictability. That's key. So FX volatility is no longer a daily headache for them.
Hey, enjoying the episode? Tap follow for more. Done? Let's get back to it.
No, I appreciate it. It's great to get a real life example as well. That's great. Before we move on, Trevor, did you have anything to add on to that at all, or should we move on?
No, I just thought, thanks for the invitation. I just thought, in actual fact, that example's quite a good one. And I think with the volatility in the BRL, then that would absolutely make sense. And I think more and more clients are not just looking for that sort of credit facility, but also for the bespoke solutions. And I think that was something that Chris was able to provide for the client, because sometimes we're finding that they come to us and say, well, actually, here's something that's off the shelf, or that I've been suggested by my current provider. Can you provide anything quickly? And can you provide the right thing quickly? And Chris, is that something that you're able to do?
Yeah, absolutely. So it's about taking a portfolio approach to managing your FX. It's very much like looking at your own wealth, or how a wealth manager undertakes its portfolio. Some of it will be quite defensive, which in our case might be forward contracts. Some of it might be a little bit more aggressive, so maybe leaving it open to spot. But then there's a sort of hybrid in between that we're able to offer with structured products, which is a blend of both. So by not just having such a static approach to hedging with just, okay, I'm either going 100% with forwards or 100% leaving to spot. That's where Corpay can come in to help structure a hybrid solution to meet in the middle, where we can still provide you with guaranteed protection, a floor, but then provide you with that ability to have upside participation. You can either pay for a premium up front for this, or potentially we can structure it at zero premium to the client as such, which dramatically, again, reduces the hedging costs.
No, thank you very much, both, for that. So I was going to go look a little bit more of a macro overview now. Trevor, you also mentioned a bit even on the panel as well about dollar rates and how that's impacted things. Yeah. Would you say there are any dangers of only hedging financial products in USD? Do you think some countries, or why would some countries potentially move away from that?
Yeah, and obviously the dollar's the reserve currency and it's probably going to continue that for some time. However, we are actually seeing clients, etc., also moving away from the dollar. And actually the dollar the world is becoming sort of like a multipolar world, to be honest with you. So when you look at trade basically being now sort of denominated in Chinese currency, rare earth trade, very, very important, how that could be priced. It means, in actual fact, hedging is becoming more and more, and hedging dollars is becoming more and more important. And it's a slightly different market, but there was an FT article a few months ago now quoting, it was Deutsche Bank research. And when investors basically invest in US products, in US markets, it used to be historically, they'd sort of invest in the US product and then they turn around and say, oh, I don't really need to hedge because the dollar's relatively strong, et cetera. They'd only hedge 8% of their exposure. But now they're hedging 80%. That's a really big change because they're saying, well, actually, the dollar volatility, and also I don't really know, after seeing so much weakness this year, then I do need to hedge. In that case, it's sort of pushing clients to not only to hedge, but also to look at other providers for those bespoke solutions. So historically, you may have time delays from some providers, trying to get different solutions from those providers and then being given, one size fits all. When in actual fact, it could be the case that you need to look at another, or clients can look at another provider and say, well, actually, this is exactly what I've got. Can you help me? What sort of credit terms can you provide for me? And what sort of solutions can you give me? And I think it needs flexibility. And that comes down to size, if you can, with size and speed as well. I mean, Chris, does that sort of strike a chord with you, Chris?
Yeah, I think so. Working in a company, it's Treasury 101, diversify your counterparty risk. So obviously working with an array of different banks and brokers, and each have their different advantages and disadvantages, where, say, the broker model sort of fits in. If you're working with a bank at the moment and you haven't explored a broker before, the real key point, or the key point of difference is you're looking at a broker. It's not the same process of setting up with a bank, and it's the speed to market that you're going to get in terms of a compliance decision, in terms of onboarding. So the speed to market is what you're going to get with a broker, so they can complement each other. Working with your bank, working with a broker is not meant to obviously take over what your bank is doing. It's meant to complement your business in terms of speed to market. So if you need a quick decision, you've got a massive contract that's come in and it's in a foreign currency other than your own, a decision to get a hedging facility can potentially take months or up to a year potentially to get that facility in place. But working with a broker, you can get a decision really quick to sort of fill that gap effectively. It's always important to diversify your counterparty risk and diversify the institutions that you work with as well to try and react quickly.
Okay. If I can just jump in there actually, Chris, how long do these ISDA arrangements take to set up sometimes? How quick and how slow can they be? Not to denigrate them, the court, because they're great. They can be good solutions.
Effectively, on average, an ISDA arrangement might take anywhere from 12 to 18 months to set up with a bank. In terms of the onboarding times it takes, and obviously the compliance requirements internally, going back and forth, that can take some time as well. I guess that's been our success as well, is sort of meeting in between, say, going into an ISDA arrangement where you go into a master agreement with Corpay or an application with Corpay, and the go-to-market time is much quicker in that sense.
And actual fact, so before you have the ISDA, you could actually turn to a broker and say, listen, can you do something a bit quicker while I'm waiting? When the ISDA's up and running, then that's great. But actually you can complement and they can run alongside each other. Does that sound good?
Yeah.
Okay, lovely. Thanks, Chris.
Very interesting. And I think it sort of epitomizes why you utilize services like this, right? This is why you utilize the expertise. And I think this podcast is hopefully going to show just how important that is for clients to not take for granted. So thank you both for that. Great way. We've got a few minutes at the end. I think a great way to end is perhaps get both of yours projections on what do the next 3 to 5 years look like in this space.
You know what? I think a reasonable base case could actually be, well, I think we're going to see this sort of volatility continue. I don't think the US administration is going to change from its path. I think there's going to be various legal reckonings and challenges to that. But I do think that the US administration is quite dedicated to its path. Interestingly, you've got the midterms this time next year, November next year. So we'll have to see how that works, whether they lose one of the houses, should we say the Senate or the House of Representatives. And if they don't, I think you'll continue to see this elevated volatility. If you do, maybe it will come down, but there's certainly something that we need to consider. And then, of course, you've got the elections coming again in 2028. But certainly, I think the world is changing, and that may well continue for the next 3 to 5 years, I would think. And that's going to impact on the dollar and also the currencies. I mean, very interesting what's happening in Brazil, as Chris was explaining. So, yeah, it's going to be busy.
I guess in terms of where I see the next couple of years going, it is, again, probably a deglobalization starting to build up again from sort of when Trump was elected with the tariffs implemented. It's obviously going to be interesting to see what happens come Christmas time, as Trevor alluded to in the decision, what happens there. But that could have a potential impact on where we sort of go from there on that theme. But yeah, obviously during the Trump term, and it seems to be a bit of a global theme at the moment, not just in the US, but most of the world is sort of afraid to take that leap to do global trade at the moment because they're sort of waiting to see what happens in the US. And it is tough for a corporate to go, am I going to go into a 3-year deal in the US when there's sort of these impeding decisions happening in the background, let alone at a micro level as well. That's going to have a bit of an impact over the next couple of years, definitely in terms of growth, as people are a little bit more cautious about taking that leap into international markets. So will be interesting.
So there we have it. I mean, potentially more volatility. I think that's what a lot of people are also predicting. So it could be an interesting next 5 years. A lot could potentially happen. Thank you very much to both of you. Thank you to Trevor, thank you to Chris, and thank you to Corpay for partnering with us on this. This has been very interesting. This has been Trade Finance Talks. Thank you very much for listening.
Thanks, guys.
Thanks.